Have you ever looked at a market index, maybe the S&P 500, hitting new highs, and you get that little voice in the back of your head just whispering, is this real or is something else going on?
Yeah, that feeling.
Today on the deep dive, we're giving you the tools to either validate that gut feeling or maybe put it to rest. We're plunging into moving average breadth indicators.
Powerful stuff.
Right, a really powerful set of analytical tools that let us look beneath the market's surface. So our mission for this deep dive is to explore how these indicators can confirm a bull market's true health.
Check its pulse, basically.
Exactly. And detect crucial warning signs as it matures, and maybe most importantly, help you differentiate between just a minor wobble and a really significant correction.
A big difference there.
Huge difference. We're pulling our insights from a really fascinating YouTube video from Stock Charts TV. So what's really happening when the market seems to just defy gravity?
That really is the core question, isn't it?
Yeah.
These indicators, they're almost like getting an X-ray of the market.
That's a good way to put it.
They offer this, well, profound shortcut to understanding market momentum. It lets you cut through all the daily noise and really see the conviction, or maybe the lack of conviction, behind those headline numbers. It's about seeing the internal workings, not just the pretty facade.
Exactly. And to understand those internal workings, we probably need to quickly re-anchor on a foundational concept, moving averages.
Good idea. Back to basics for a second.
Yeah. So for those already tracking market trends, we know they smooth out volatility, but what makes the 20, 50, 100, and 200-day simple moving averages, the SMAs, what makes them particularly powerful for what we're talking about today?
You're absolutely right to start there. Moving averages are, well, they're your essential trend spotting tool. They filter out that day-to-day static, helping us see the true direction of price movement. The specific SMAs we'll focus on, the ones highlighted in our source material, are key for different time frames. The 20-day, that's your short-term tactical gauge. The 50-day represents more intermediate trends. Then the 100-day, and especially the 200-day, those are your critical long-term structural indicators.
Right. The big ones.
Exactly.
Yeah.
And while, we often look at their slope or maybe various crossovers, like a golden cross when the 50-day moves above the 200-day.
Sure.
For our discussion today on breadth, the most important aspect is simply this. Is the asset's price above or below a particular moving average? That simple comparison, that's the bedrock of everything we're about to explore.
Okay, so using that bedrock concept, let's look at the S&P 500 itself first. Just by watching how this flagship index interacts with those four key moving averages, we can start to get a sense of the severity of any market pullback. What does breaking specific MAs signal about the market's health?
Yeah, this gives us a really useful kind of severity scale, and the source material offers some clear historical S&P 500 examples to illustrate it.
Okay.
Think of it in terms of how much support the market loses. So a brief pullback, that's when the S&P 500 only dips below its 20-day MA.
Just the short-term one.
Right. It's often fleeting, just a bit of market turbulence, like we saw back in late October, early November 2024. It suggests short-term weakness, but crucially, the S&P quickly finds its footing. It holds above the 50, 100, and 200-day MAs.
So a blip.
A blip, exactly.
Yeah,
not a reversal. It confirms the main uptrend is still, robust.
Okay. What's next on the scale?
Then you have a more significant decline. This is let's say, a deeper retest of support.
Mm-hmm.
Here, the S&P breaks both its 20-day and 50-day MAs. That indicates more widespread selling pressure over the immediate term. We saw this pattern from December into January.
I remember that.
Yeah. However, the long-term trend, it still remains positive because the index holds above its 100-day and 200-day MAs. So it's a deeper correction, needs more attention, definitely,
Right.
but generally not a full trend breakdown.
Right. Still holding the long-term picture.
Exactly. And then finally, there's a major correction. This is the one you really need to be prepared for.
The serious one.
Yes.
Serious one. Here, the S&P breaks all four of its key moving averages, including that critical 200-day MA. That period from February into March 2025, with the 200-day actually breaking in early March, that's a prime example. Yeah. This signals a fundamental shift. It indicates a much more severe structural breakdown that often demands a more defensive posture.
Makes sense.
So the underlying logic is pretty clear. Price above all MAs. Trend is robustly bullish. Below all, firmly bearish. And if it's somewhere in between, well, the number of MAs broken acts as a simple, effective gauge of how severe the market's current weakness is.
That severity scale is really powerful for understanding the S&P itself. But okay, what if the S&P looks relatively fine, maybe just pulling back a bit, yet there's this sort of quiet decay happening beneath the surface? How do we catch that? That seems to be where we move beyond just the flagship index and look at the entire fleet, right?
Yeah.
The concept of breadth. That's the critical distinction, exactly. Moving average breadth indicators provide that deeper insight. So instead of just watching the S&P 500, we're actually measuring the percentage of stocks within an index
Okay, the percentage.
that are trading above their own respective 20-day, 50-day, 100-day, and 200-day moving averages.
Got it. So it's not just the index price, it's the components.
Precisely. It tells us about the participation in a market move. Is it a broad-based rally? Or is it just being dragged higher by, a handful of mega cap stocks?
It can happen.
Oh, absolutely.
Yeah.
This isn't just some technical signal. It's like the market whispering about the underlying strength or weakness of its components. And you can apply this to various indexes. The S&P 500, obviously, the NASDAQ 100, the S&P 600 for small caps, or even the broad S&P 1500. And the good news, these are easily trackable. Platforms like StockCharts.com's market summary page provide these right in the breadth section.
Handy.
Very handy. The source gave us a snapshot for the S&P 500 as of September 15th, 2025. At that time, roughly 50% of its members were above their 20-day MA.
It's okay, neutral.
Yeah, neutral, often colored amber. 59% were above their 50-day, also neutral amber. But then over 65% were above their 100-day.
Bullish.
Bullish green, yep. And 64% above their 200-day, also bullish green. That instant color coding gives you a quick visual assessment. And the 50% threshold is really key here. Above it generally suggests bullish conviction. Below it leans towards bearish sentiment. It's a snapshot of the market's underlying health.
So the actual buy-in from individual stocks tells us a lot more than just the index's superficial price level. That feels like a crucial distinction.
It really is.
But to truly bring this to life, let's revisit that brief history lesson you mentioned from the last year. See how these breadth indicators revealed the market's true colors during those pullbacks.
Absolutely. Let's go back to that October 2024 pullback. Now, the S&P 500 index itself only broke its 20-day MA. If you were only looking at the index, you might think, oh, just a minor dip.
Right, not too bad.
But the breadth indicators told a more nuanced story. Only about 32% of S&P members were actually above their 20-day MA at that point, and only about 50% were above their 50-day. But critically...
the longer term.
Exactly. Most stocks still held above their 100-day and 200-day MAs. This confirmed it was just a short-term shakeout, not a deep structural issue. Most individual stocks were still participating in the longer-term uptrend. That's exactly what you want to see if you believe the bull market is still fundamentally intact.
Okay, that makes sense. It differentiates the shallow from the deep.
Precisely. Now contrast that with the more significant February-March 2025 correction. Here, the S&P 500 broke below all four of its key MAs, remember, with the 200-day confirming that break in early March.
Yeah, that was much uglier.
Much uglier. And the breadth indicators during this period, they were unambiguous. All of them plummeted well below that 50% level. By the time we hit the market low in early April, a staggering only 20% of S&P members were holding above their 200-day MA.
Wow, only 20%.
Yeah, that was a clear, widespread market breakdown. It signaled a much more severe, less desirable environment for taking on risk. It's a vital lesson. The index might show one thing, but breadth shows how deeply rooted, or not, that trend really is. And it's worth noting the typical breakdown pattern, too. The percentage of stocks above their 20-day MA, that usually dips first. It's the most sensitive.
Makes sense.
Then it's followed by the 50-day, the 100-day, and finally the 200-day breadth. That 200-day breadth, though, that's the true long-term barometer. If it holds above 50%, conditions might be challenging. Maybe choppy, but probably not dire.
Okay.
But if it breaks below 50%, that's when you really need to start thinking defensively, as the source material puts it. It's a powerful validation of market strength or, well, weakness.
So it sounds like these indicators aren't just for confirming what's already happened. Where do they truly shine in helping us maybe anticipate trouble before it becomes really obvious on the index chart?
Now we're getting to the really good stuff. This is where they become invaluable for spotting those early warning signs. Specifically through something called bearish breadth divergence.
Divergence, okay.
Yeah. This is a critical red flag. It's often a signal that the market might be entering its leader innings, so to speak. It happens when the S&P 500, or whatever index you're tracking, makes a new high. But underneath the surface, the percentage of stocks above their MAs starts sloping downwards.
So the index is up, but fewer stocks are actually participating in that move up.
Precisely. Fewer and fewer stocks are carrying the load. The market's being driven higher by this shrinking group of leaders, while the broader base of stocks is actually starting to weaken, maybe rolling over already.
Interesting. Why is that so crucial?
Well, it often suggests that the smart money might be quietly stepping aside, selling into strength, leaving the broader market to be driven by fewer and fewer, often the last, participants. It's the difference between a healthy, broad-based rally and a narrow leadership rally that often precedes a significant shift or correction.
Like a warning flare.
Exactly like a warning flare.
Yeah.
Let's look at that February 2025 peak again. The S&P made a new high, around 6150 in mid-February. But right at that exact moment, all the breadth indicators were visibly sloping lower.
All of them.
All four. The percentage of stocks above their 20-day MA, for instance, had plunged from around 80% back in late January down to below 50% at that February peak. That divergence was a clear precursor to the correction that followed soon after. It's a powerful example of how breadth can give you a kind of forward-looking signal.
That's a very powerful warning sign. But, sometimes a market can be driven by just a few mega-cap stocks and still keep grinding higher for a while, right? How do we differentiate a true later innings signal from maybe just a temporary shift in market leadership, where perhaps the smaller caps are just taking a breather or consolidating?
That's an excellent question, a really important nuance. And it's where looking at the longer-term breadth indicators becomes crucial. A temporary shift, maybe just rotation between sectors or cap sizes, might see the 20-day breadth pullback, sure, but the 50-day, and especially the 100-day, and the 200-day breadth would likely remain robustly above that 50% level.
So the underlying long-term health is still there.
Exactly. But if all the breadth indicators, including those critical longer-term ones like the 200-day, start to diverge significantly downwards while the index makes highs, then it's much more likely to be something more than just a rotational shift. It suggests broad-based underlying weakness is setting in. When I first started really tracking these, it was like someone handed me X-ray glasses. Yeah, seriously. I started seeing things beneath the surface I had never noticed before, and it completely changed how I approached understanding market risk.
I can see how it would. Okay, so let's connect this directly to our current situation, mentioned in the source, September 2025. The S&P has recently made new all-time highs, trading above 6,600 from late August into mid-September. Pretty bullish on the surface.
Looks great on the surface, right? But here's the concern, the potential divergence. All four of our breadth indicators, the 200, 150, and 20-day percentages, have been noticeably sloping downwards over the last 3 weeks, even as the index pushed higher.
All four again?
Yeah. And specifically, the percentage of stocks above their 20-day MA has fallen pretty sharply, from around 80% back in mid to late August to only around 50% now, right near that threshold.
So that divergence is happening right now.
It appears to be, yes.
Yeah.
This current divergence is, as the source puts it, a significant red flag waving a little bit.
Okay, so what should we be watching for very closely now?
The key thing to watch is whether the percentage of stocks above their 20-day MA can hold that 50% level. If it bounces back strongly from here, maybe it was just short-term noise or consolidation within the uptrend.
Okay, a possibility.
Possibility. But if this divergence continues to play out and these indicators, particularly that critical 200-day breadth, start to break decisively below 50%, well, the source suggests that would confirm most likely a bull market top.
Wow, okay. That's a strong statement.
It is. It shows just how much weight experienced analysts put on these breadth signals. It truly is a powerful way to try and be proactive rather than just reactive when the index itself finally rolls over.
It really sounds like these indicators give us this incredibly powerful lens to see what's really happening under the market's hood. It lets us anticipate potential shifts instead of just reacting after the fact. That feels like a game changer for becoming truly, genuinely well-informed.
It absolutely is. It's about moving from simply observing the price to truly understanding the market's underlying health, its internal strengths or weakness.
So to quickly recap our deep dive today, we first established that really useful severity scale just by watching how the S&P 500 interacts with its key moving averages, differentiating brief pullbacks from those major corrections.
Right, the basic framework.
Then we expanded that concept dramatically, really digging into the power of moving average breadth indicators to reveal the true participation. How many individual stocks within an index are actually on board? That's the conviction behind the headlines.
The participation story. Crucial.
And maybe most importantly, we learned how to spot those crucial early warning signs, those bearish divergences, when the index makes new highs, but fewer and fewer stocks are actually joining the party.
The red flags.
Exactly. These tools truly empower you, the listener, to quickly become, well, much more well-informed about the underlying health and momentum of the market you're watching.
And if we just connect this to the bigger picture for a second, understanding these historical patterns, these ways breadth behaves at tops and bottoms and during corrections, it really allows us to interpret current conditions far more effectively. By watching for these specific shifts in breadth, like a divergence we're seeing now, you're not just reacting to the market anymore. You're starting to develop a more anticipatory mindset about its potential next moves. So maybe consider this. How could this kind of insight change the way you view the daily market news or even your own approach to understanding these market cycles? It could give you a significantly more sophisticated understanding of market health and, crucially, potential risks that aren't always obvious from the headlines.
That's a fantastic thought to leave everyone with, and certainly a powerful lens to add to your analytical toolkit. Thank you so much for joining us on this deep dive into moving average breadth indicators.
My pleasure.
We really hope you feel more equipped now to understand what's truly driving market momentum beneath the surface. We'll get you next time on the deep dive.